the token, that's associated with it. We'll see what happens there. But yeah, man. So Quincy,
Awesome.
what
How you
do you
doing,
want to
gang?
run down, man?
Honestly, I'm down for anything, man. Last time I had you on, now you have me on. So, hey, you lead it, man. What type of topics you want to talk about? I'm all for it.
Um, I kind of started it off by saying we would run down like tokenization of real world assets, financial products. It's kind of you and I we jam on that pretty often. I think that
I
could
love
be
that.
something that's valuable for people. You always give some fantastic insights into stuff. Um, like I said, when I first saw you on Matty G's channel, and then you kind of blew up, you've made a bunch of videos that kind of opened my mind to some of the different possibilities for how this will actually work in real world applications. One of my favorite paradigm shifts that you enabled me to have was like both sides of the ledger. So you have to think about, you need liquidity on chain to provide transactions for the debt and the assets, because somebody's debt is somebody else's asset.
Yep.
So whatever you think is all the money, just go ahead and double that. It was like, I wish I had the gift for the guy that's it's mind blown.
I love being able to talk about real world assets, especially talking about debt. Debt is just an interesting instrument that can actually be automated on chain. So it's actually really interesting what we can do with that, especially when we talk about tokenization. People like to talk about tokenization of money, tokenization of securities. When we talk about tokenization of debt, you're really just talking about the automation of the contract that is debt, whether it's lending, and then being able to tokenize that contract and being able to sell that, or at least the rights to it.
Right. Well, so and you'll like this. I think that we're not too far off. We're not done yet, but I'll mention this. We are working on an application that allows for basically people to aggregate their XDC together and then deploy that into a node in a compliant manner, and then be able to receive the distributions for their the amount of the XDC that they pulled together. Whatever they put into the pool, their percentage, they'll get that yield on their XDC for participating in that. So master node on the network pays 10%, standby nodes 8%. You've got to factor in costs, and if you're working with somebody that is managing that node, there's costs associated with it. So it'll at least pay people a yield. But what is that worth on a secondary market, right? Like the derivative of that, your equity piece in that node that pays that distribution, what could you sell it for to a pension fund or somebody else that wanted, monthly cadence of distribution of XDC? I think that you could get a pretty significant premium on a secondary market for that. And, that's, again, not necessarily a debt instrument. That's more of an equity instrument. But, all of these things where people issue loans and then you have collateralized debt obligations, and then those are rolled up by the banks and then sold off. Like people don't realize they can, if you're owed something, you can create a financial product and sell it to somebody else. And you would value that with the depreciated cash flows and whatever the appreciation or potential appreciation of the underlying asset would be.
Actually, I'm glad you bring up something. I'm glad you bring something like that up. Because it does act a little bit like like an equity instrument. It almost takes like a software as a service, rerunning the node. It almost creates an equity instrument off of it based off of your ability to generate revenues off of that. And never before has there really been something like that. Like, how many times can you be able to sell equity in a service that generated revenues based off of its ability to, in this case, promote the network or run the network? But most of the time, it would just be you running a business to do that, as opposed to you being a part of an open source service. So it's really interesting to see what you can do with that.
Yeah, it's going to be, I think that there's going to be a lot of different applications that become possible with this that are, different than traditional financial products that have existed. There's some people asking in the chat if you want to run down some questions here.
Let's do it. Let's run it.
Yeah, if y'all have questions for Quincy, run it up, put it out there in the chat. He's a wealth of knowledge. Excited to have him here with me, and it's gonna be cool to see, what you guys want to know. So I know that you're working on some interesting things. Have you found anybody on the commodity stuff that you were looking at?
Oh
Or
my
can
goodness,
you
I
even
could
talk
actually
about it?
go. I can go deep into a lot of things. Yeah. So yeah, there was quite a bit of time where I was actually super interested in commodities. I actually approached you about this too.
Mm.
In terms of what it means for tokenization, in terms of what it means in terms of creating higher efficient products or at least higher efficient services around commodities. Now, the thing that I found very difficult for a while, I worked on a set of smart contracts focusing on tokenization, focusing on taking certain assets and bringing them on chain and putting them onto these DeFi markets. That's why I focus on commodities so much, because people like to talk about securities, people like to talk about cash, people like to talk about currencies. But in my book, I'm like, well, honestly, one of the biggest assets that are a little bit underrated is commodities, primarily due to the fact that there's like a huge global commodity trade, and usually the biggest thing about that is taking some sort of derivative asset and then tracking that along a supply chain and then making sure you're able to maintain delivery. I thought that was one of the greatest things you could have for crypto or blockchain, simply because of all the different use cases we talk in that regard. So there was a time about almost 6 months where every single conversation I would be talking about commodities, tokenization, and how you can break real world assets and bring them on chain. Now, funny enough, people normally go, oh my goodness, how does the code work? How would you basically implement these tokens? All this. And I used to think the same way too. I used to think that was the hard part. That's not the hard part. Sort of establishing business relationships and then being able to find a way to be able to tokenize these assets for these businesses and create a more efficient product is almost the hard part. And that's not even the hard part. There's almost like a relationship needed between the people that are tokenizing the assets and the people that they're trading with too. So maybe you found a trade partner and maybe they're willing to tokenize, but if that's not part of the same technology stack as their other trade partners, then you don't necessarily even have a product. You sort of just have this idea that could be utilized, but you need to essentially find your trade partners to also onboard and utilize that as well. So what I ended up finding was the hard part isn't so much tokenizing commodities or even the software around tokenization. It's being able to find and establish a set of relationship between a set of trade partners that are going to use the technology in that way to create a more efficient business. And now it's almost like I'm spending more time, instead of actually focusing on the code or explaining the code, but seeing how different businesses, trade partners, SaaS services can utilize these software and how they can establish a relationship with their already established trade partners and new trade partners while utilizing the blockchain. It sounds silly because you're like, oh, well, once they tokenize it, isn't that all? And it's like, well, not quite. They still need to be able to send and receive and maintain and keep account of the assets that you're essentially tokenizing. And that's like a social relationship, not a technical one.
Yeah. I think that's the piece that people have a hard time with, right? Like you can create all this cool, sexy stuff, but unless people realize the problem exists and this is a solution, they're not going to be willing to adopt it, right? And unless you have somebody on the other side of that trade to facilitate it, and that's so the AMMs on the XRPL provide liquidity for the other side of that trade, but you still need a market, right? Like you have to have somebody that's willing to buy and sell on either side of that transaction. You could have the liquidity, you could have the items tokenized, but if there is no market to make those transactions, then it doesn't matter. Like you can't have a one-sided transaction.
Exactly.
I guess you could. You could build a code where, you automate the buy of something that you want to aggregate over time, right? But yeah, to be until a large majority. Well, okay, I'll say this. I think that these applications and the smart contracts and the markets will exist in silos, similar to the internet in the short term. I think specific people will create markets for themselves where they buy and sell within a silo. And then over time, other people will develop markets for similar products or the same product. And then distributed ledger technology allows for those to be interoperable. Right, so kind of like the internet of value, but until we have the internet of value, we'll have the intranet. Where
actually, yes.
you have AOL, and to email me, you also have to have an AOL email or a Yahoo email. My email doesn't go to your email.
Yeah, And actually, I'm glad you actually brought that up, because it actually gets into this idea of what's the point of blockchain, the point of tokenization. There are going to be these siloed networks, especially when it comes to permission networks, especially when it comes to private networks, sub networks, and especially when you start looking at these localized economies. When people start talking about stable coins and CBDCs and all of that. But the primary use case of blockchain is to bridge these localized networks. So you may have a localized network in the US, you may have a localized network in, let's say, Japan. They may use a CBDC or even a stable coin or whatever, or a set of permission networks. All of that may be fine within their local economy, but when they need to interact with somebody outside of their economy, outside of their payment network, outside of their currency network, being able to utilize the blockchain and being able to utilize assets as a settlement mechanism becomes a huge point of I guess you could say of what's it called? It becomes a huge element in terms of how they're able to conduct trade in a more efficient way. And in doing so, yeah, they may be able to use subnets, permission networks, all these things in their intranet, sort of like you said. But being able to exchange with people on a global scale is essentially going to be the internet of value, in a sense, where people are able to exchange assets and they can settle them in Japan, settle them in the US, settle them in Brazil, settle them in Russia, settle them in Europe or whatever. And they may have their own intranets in those independent regions where they may be utilizing stablecoins or CBDCs or whatever it may be. But that internet, that interconnected element where you can bridge economies is one of the biggest components, or one of the biggest reasons blockchain is so valuable, or blockchain technology is so valuable.
So here's a good question. Appreciate the super chat on this. So Elis has asked, what's a conservative percent number for global trade that XDC can capture? 1%, 10%? I don't know. I'll let you handle that one first, and then.
People like to look at things in terms of totals. So people like to go, oh, like the market cap of gold is this, or the market cap of oil is this, the market cap is this is this. Can it encapsulate all of that? The real question you should be is trade volume. I think people totally miss this. It's not even it's not even really about the total amount of assets on trade. It's really about the total trade volume that can be facilitated on chain. So, and the reason I bring this up is, maybe from a macro standpoint, being able to look at all the assets that are tokenized on chain is great, but the real answer is how many of those assets are being traded. We like to talk so much, or a good example of this is, you could tokenize $1 billion worth of assets on trade, or on chain. That would essentially do nothing in terms of the total demand for the asset or total demand for the network if people aren't actually engaging in those assets, aren't trading those assets, aren't using the native cryptocurrency as a form of capital to be able to make payments for those assets on chain. So the real name of the game isn't so much of what are the total amount of assets that can be traded that can be tokenized on chain. It's what would the trade volume be at scale with multiple businesses and multiple assets being tokenized, and then people exchanging those assets on chain. That's the real question. And if you want to look at that, you can start looking at other fields in trade finance and start looking at okay, what's the total trade volume today on it, and what would that look like if it was on chain? And one thing that's actually beautiful about that is, on chain it would be higher than it is currently, not for any arbitrary reason, but solely based on the fact that you're able to do settlements faster, you're able to move capital faster, you're able to do a lot of these settlements and a lot of these payments so much quicker. So instead of having money locked down and sitting for 2, 3, 4 days over the weekends, whatever it may be, you can essentially have these payments happen almost instantly, allowing for further economic growth.
Yeah, so payment volume, right? Like people oftentimes will ask me, XRP in particular, I have affinity with that ecosystem, and we talk to a lot of people there. I have biases when it comes to that, but we talk about Swift, right? And what's the transaction volume for that payment network on a daily and annual basis? And that's the number you use. You don't use how much currency would be tokenized on the XRPL to facilitate all of that trading. You would look at the volume of trades on a daily or annual basis, and then that's the number you would use to figure out the value or the liquidity that token would have to provide for those transactions.
Absolutely. Absolutely.
And it's not like some people are so used to looking at businesses and valuing them via market cap. And I don't want to say that that's not an important metric. It is, but as far as you brought it up, the volume on a network is what's going to drive price of the underlying native asset that's going to facilitate those transactions.
Exactly. You can even look at this in any and you can actually look at this in any other market or any other asset. If you look at oil, it doesn't matter how much oil there is in the world. What matters is how much oil is being traded currently in the world. And if there's a higher demand in oil to be traded, you're going to see a spike in price solely based on the fact that there's only so much. This is where people get so hung up on like tokenization and how many assets and what's the total supply and all that. But there's an element of, look, fundamentally speaking, if more people demanded a limited supply of a certain good, there's going to be an increase in the price of that. The only difference between oil and cryptocurrency is the demand in the supply, or the demand in the asset comes down to the demand in volume for assets that are tokenized on chain, while the current I guess you could say native asset is used as a form of capital to exchange those assets that are being exchanged on chain, that trade volume. And yeah, the name of the game is tokenize as much as possible and trade and get that trade volume as high as you can. A lot of people like to focus all on these crazy metrics for crypto and all of this, but at the end of the day, it just comes down to trade volume. We even let's just forget tokenization. Even if you just looked at the exchanges, it's trade volume. It's not about how many people got into crypto. It's about what the current trade volume is and how much the trade volume go up in the past 24 hours, 48 hours, week, 2 weeks, whatever. Yeah. If the trade volume goes up, you're going to see a spike in terms of the demand for the price.
Yeah. And so back to the question here, and I've kicked it off, but I'll pull it back. What's a conservative number or percentage of global trade that XDC can capture? You know, again, it's going to come down to adoption and relationships, right? So who are the first movers that see the value in transacting on chain and are willing to adopt the tokenization of the assets to facilitate the trades in a more effective and probably less costly manner, right?
That's actually a good. I love that you put that down, because a lot of people go, "What's the benefit of the blockchain?" One of the benefits of the blockchain is just more efficient, hands down. You're able to run the same. You're able to run the same level of trade volume. You're able to run the same level of business, but you're able to run it more efficiently. So the real name of the game, especially to that question that you asked, the real name of the game is, well, of all the trade finance out there, how much of it can operate on XDC? Technically, all of it can operate on XDC. That's actually what we're fighting for. The real name of the game is how much activity in trade finance is going to operate in this domain as opposed to this domain. You know, we like to talk about XRP and XDC. Maybe with XRP, there's a huge focus on foreign exchange currencies, and the forex market takes off on XRP in terms of no Nostro, cross-border remittances, currency. Let's say on XDC it's derivatives. Let's say on Ethereum it's retail-based assets. It's really about capturing how big of a market can you capture on a specific network. So in theory, all of it. But the real name of the game isn't what can other networks do that are competing with you. The real name of the game is what type of activity is persisting on what networks, and what type of competition is there for people to go from this network or this network. You know, why would I go to XDC if I see this trade finance when I could see trade finance on these other networks? Now, currently, XDC seems to be one of the leading networks for trade finance, so obviously that's a huge competitive advantage. But it's not just that too. There are other, like, I guess you could say, sub levels of activity that are in there. Like I said, when it comes to like you can consider foreign exchange trade finance, but I'd honestly see foreign exchange being huge on XRP, or on XDC it maybe focus on derivatives or focus on commodities or something. So, and don't get me wrong, a lot of these are very vague too. If you really wanted to break down finance, and I bet Jake could probably do a better job than I can, you could break these down into subdomain versus subdomain to subdomain. There's so many different domains, so many different levels of activity, so many different things that are going on at the same time that there's plenty of activity in the markets for there to be enough volume on a lot of networks. And I don't mean this to say that everyone's going to make it on every network, but you have to look at the networks for what type of activity can they facilitate, and how much of that activity can they capture. And like I said, we focus on trade finance, but there are also elements in that we also focus within that too. And at least for XDC, I think the biggest thing is going to be commodities, is going to be derivatives, and it's going to be automating trade finance services that would otherwise be perpetuated by third-party services. But that's the thing, though. I can't give you a perfect number, a perfect answer on that. That's like a macro. That's like saying, okay, if you took 1,000 businesses that came together and did something, what network and what activity would they possibly use to be able to use these things? It's like, that's kind of on them to choose. All I can do is basically frame it in such a way that would make them more likely to choose this network versus another. Now, don't get me wrong. Like, XDC does so many great things, and there are plenty of people that are focused around XDC. But at the same time, too, there's an element where maybe there's a certain level of activity that could be facilitated on another network that people may like. So it'd be a little bit unfair to say, well, because we can do this, all the activities gonna happen on this network. We try to facilitate that, but it's solely based off what type of activities are facilitated on certain networks, and then people gravitating to that activity. So really, what you want is just not people to get into a network, but to get into a specific type of engagement on a network. You see what I mean? It's not so much for them to hold XDC or XRP. You want them to be able to run some aspect of their business on this network in a manner that's more efficient, so you can have this continuous growth or the continuous demand for that network, and then have that on a macro scale. So instead of one person, you have 10, 100, 1,000 different people all doing that same level of activity, and that's all contributing to the demand of the network.
Yeah, no, it's brilliant. So one of those niches, we were in Austin last year at XDC, on XDC, Lloyd put that event on. Great job there. He's got one in Dubai this year. I think it's in May, that we'll likely be attending. And we had Andre Casterman there, and he's really built out the infrastructure for the trade finance component. His company's called TradeFi. He's out of the UK. He's a previous Swift employee. And he basically, implemented the ISO standards for the bill of lading and these other, the communications for trade, right? Like, because that's a precursor. I don't think a lot of people understand that you have to have, that's kind of the bedrock before you can have instant settlement and efficiencies in a market. There has to be a standardization of the communications in a market so that everybody's supplying the same data in the same manner so that it's easily transferable. And he's done that for trade finance, the bill of lading, and the other things that are required for that. And then those are debt instruments as well, so they're collectible, right? You've got sometimes net 30, 60, 90 days, and these people need capital now, right? Sometimes you're, as a company, you don't want to wait for another company to pay you, and so if you're net 30 or net 60 and you need capital, you might be willing to take 10% less on that note to have that money today. And so you could sell that to somebody else that's willing to wait for that payment. And I think there's a huge market there. Him and I had a talk about family office and some of the capital that's being deployed in those markets and how sustainable that is for the yield that they're getting. And they're earning, sometimes 9, 10, 12% on 90-day loans, basically, against the notes as collateral, which is pretty interesting. So if they're able to facilitate that on chain at scale, I think that opens up those doors, and then you can democratize things too. Like, that's the other cool piece of this that I think a lot of people miss. A lot of these financial products and instruments have only been available to extremely wealthy people for an extended period of time. Like, you've had to have the capital to be able to deploy to make this meaningful for people. But now with this technology and certain crowdfunding and other things, I think that a lot of these potential applications where you're able to earn pretty decent yield on your money will become available for, I don't want to say the little guy, but people a little bit further down the chain that have, $5, $10, $50, $100,000 to deploy instead of, millions at a time. These opportunities can come available to them. So excited for that component of it. And I think you're right. If you find a niche that has pretty significant volume and you can create efficiencies within that market and incentivize the players there to come on chain through relationships that you develop, that's where the magic happens.
I'm actually glad you brought that up too, because people talk about like fractional tokenization, and that's actually one of the biggest things. There are certain things that are incredibly illiquid. A lot of people don't truly get how illiquid certain assets are. I had a conversation with one of my coworkers, and we were talking about fractionalizing certain assets. And one of the examples that he gave was, so let's say somebody's building a power plant, right? And it takes like 20 years to build a power plant. It takes a lot of investment from all around the world, a lot of people coming together. It takes a lot of work. But let's say that you're able to get a bunch of people together to be able to build this project, but you have your money locked into the project for 20 years. And even after that, maybe it's another 10 years before you even really see sort of a return on your money. You could be able to take a fractionalization of the total asset, like whether you tokenize it, and then be able to sell a portion of that to other people that want to be able to get in on that investment that otherwise wouldn't have been able to, because either A, they didn't have the money, they didn't have the connections, they didn't have the liquidity, whatever it may have been. They can now be able to have access to these fractional assets. They can now have access access to these fractional assets that are on these networks, and be able to own a piece of an asset that would otherwise been incredibly illiquid, and you would have otherwise had to have been in the meeting, in the deal, to be able to get in on, where now you can basically be able to own a fraction of that piece and be able to reap the benefits of the ownership of that fraction of a piece without having to have the capital to be able to get in on that.
Yeah, Link2 does this. They go out and acquire large tranches of private equity. They mark that up and they, fractionalize it basically, and then create those offerings to people that don't necessarily have millions of dollars. And they arbitrage that, and they make a pretty good return doing it. And I think a lot of those markets will pop up, moving forward. I think that there'll be a bunch of different applications, especially, most people are targeting real estate is what I've seen. Obviously that's a huge market. I don't know what the total market cap of real estate around the globe is, but as that comes on chain and the efficiencies that provides, like, I don't know if you guys have ever bought a home or an investment property.
Hey, I'm actually like in the process of some of this stuff too. So preach.
Dude, it is the amount of time that it takes, and the title company and the escrow and the broker and the realtor and everybody that scrapes a fee and pulls stuff off of those large transactions. I am super pumped for the day that an Oracle can pull that data on chain, attach to your bank accounts, pull that stuff in, create a smart contract that escrows the capital without having to have a third party that you pay to watch those funds, and then make the distributions and exchange of the NFT that's issued against the property on the other side of that transaction, and swap the capital for that from the loan for the bank. Like, Ripple's already developed a product for a HELOC, and it involved 5 different companies to be able to facilitate that, including them. But that's how many players are involved on these transactions. And if you can get everybody to adopt this, and it's going to take a long time before there's actual NFTs and titles issued on chain against properties, because right now it's like down at the county courthouse, like they're in a file cabinet, and it's I think it's potentially at least another 5 or 10 years before that's a reality. I think in the short term, it's likely that you could create an SPV or a company that owns the underlying asset and holds that with a qualified custodian, or has a property manager or something else that allows for you to know that that asset's being protected and safe. And then you're able to trade the equity in the company. And that's that. You can do regulation. There's compliance. Everything's in place to be able to facilitate that now with tokenized equity. I think that's probably the first. Well, so let's talk about that. What do you think the progression is of the tokenization of financial products? Like, where do you think it starts, and where do you think it proliferates over time? You think it's kind of a broad base? You're obviously looking at commodities. You think it's securities, bonds, debt notes? Like, where do you think it starts, and what do you think the progression is for things to become tokenized?
Yeah, so there seems to be a few barriers in place. Obviously, there's regulatory ones in terms of being able to recognize an asset, what it means to recognize that asset was security, commodity, currency. We talk about this in terms of like cryptocurrencies all the time. But then let's say there's regulatory clarity or regulatory, a regulatory assessment to where people feel comfortable with. You got to remember, these are also technologies. So there's an element where as much as you would love to use this technology, it's useless to you if your partners aren't using it as well. So there's a regulatory component, and then there's sort of like I don't want to call it a social component, but let's call it like a networking component, to where you need to use the software, but also they need to use the software in order for you guys to be able to communicate. And this is one of those things where like it's a cooperation thing. So there are businesses that will use blockchain and cooperate with businesses that they're already, whether they're familiar with or whether they've had previous partnerships with. There are businesses that are willing to use that. Now, most of them aren't, obviously, because there isn't much regulatory clarity. So it seems to be that there needs to be some sort of regulatory clarity first, and then some sort of social component where businesses are able to trust each other to recognize the assets that are on these chains. And it's one of those things too, because everyone gets so frustrated, like, oh, when's that gonna be? honestly, it's happening right now. There are businesses that are using blockchain for very, very, very basic use cases, whether it's version control, whether it's identity management, whether like we're not even getting into trade finance yet. We're just getting into this like basic tokenization. But as you start seeing there being a better progress on, as you start seeing better progress on regulation and recognition of these assets on chain, you'll start seeing more individual parties be able to opt into these technology stacks to be able to conduct trade. And it's a very weird, I don't honestly don't even know which one's going to happen first, because you could have a few set of businesses that come on chain and create a set of services that people will effectively really like, and maybe doesn't necessarily need to be regulatory clarity on the assets, because the individual businesses that are utilizing these blockchains are just recognizing, hey, look, you sent me this. Traditionally, we would have done it this way, but hey, I'm willing to recognize it this way because it's more efficient. And don't get me wrong, like there aren't many. Like the reason I say this is Zinfin's one of the biggest ones that I recognize in that. One of the originators of the XCC network. Zinfin has onboarded applications like TradeFinex and a bunch of other ones in Singapore at the very least to be able to conduct business that they were already conducting before they even had blockchain. And you see businesses try to do this too, but at the same time, you don't necessarily see a lot of people come on board because there's not a lot of recognition. So the real aim of the game is: will there be a big business that comes on chain and be able to create some sort of service that people recognize and grow, or will there be regulatory clarity first, and then you start seeing people starting to utilize these assets based off the regulatory clarity? Which ones to happen first, I'm not entirely sure, but at the very least, these are barriers to be able to get in. Like I said, one barrier being regulatory compliance, and the other barrier being having your trade partners on the same technology stack as you to accept those assets.
Yeah, I'm with you. I don't chicken or the egg, right?
Yeah.
Do you have people push for regulatory compliance because they want to use the technology and they're already doing it, and they say, "Hey, look, like we're going to use it. If y'all want to regulate it, get it figured out, but we don't care because it creates such efficiencies in our business that allows us to be more profitable." I think that those are probably the applications where this stuff is applied first, and it creates the most difference. Is wherever it's going to reduce the most friction, right? So cross-border payments, that's a multi-trillion-dollar problem that people talk about. You've got a lot of friction there. It's very costly. The banks eat up on the fees. That's a situation that's ripe for disruption. And I think those are probably the applications where things happen first. I think that I'm going to sound crazy. I think the stock market and tokenizing the stock market is one of those scenarios. And maybe that is demonstrated. It already has been demonstrated. So we've got GME and AMC in 2021 when we had Wall Street Bets run those up. They had to freeze the stocks. There's 6 clearinghouses and they have all the brokers, and then there's retail. So retail thinks that they're trading real time because they have an app, but they're not, because the settlement between the clearinghouses and the brokers is still T+2. And there's no accounting mechanism, and we've talked about this before, Quincy, and like same thing on commodities. There's no accounting mechanism across all of the clearinghouses and the brokers.
Yep.
So they ended up selling like 139% of the shares for AMC. And then people got pissed off because they froze the trading and took the shares back, but they messed up, and there was so much volume on it that they had such a high throughput, and obviously there's a lot of money to be made. So the clearinghouses were actually the ones that stopped the trading. They had already fronted so much money on these stocks and realized that they had been oversold that they said, nope, all the brokers, lock it down. We're done. We're T+2. We're going to have to wait to settle to reconcile this stuff, and then we'll figure out where everything is, because you guys, you sold too much. And if you had that on DLT, and we had a system that allowed all these siloed systems to talk to one another on a connected ledger, where all those transactions were not fixed, but like you could not sell more than 100% of the securities, then that doesn't happen. And it's real-time settlement, right? So then exactly. the brokers aren't out. So I think that that's probably an application where this happens first. And now we have the ETF with Bitcoin, and there's still T+2 settlement to rebalance. So if you had significant price action on Bitcoin over a weekend or over a 2 or 3 day period, and they've got to rebalance, and Bitcoin's 30% less or 50% less than what it was just a few days ago, which we see in that asset occasionally. Like there could be huge losses and implications for BlackRock and Grayscale and all of these other people that now have the ETFs that have to rebalance those. So I don't know. I think that that's probably one of the first, and just looking at, Project Ion that was developed in correlation with R3 for the DTCC that's potentially running in tandem already with public markets. I don't know. I think that that's probably one of the first pieces is tokenized securities and public markets.
Yeah, actually, I think that's gonna be a big piece too, especially your comment on like how in the dark a lot of these different whether it's clearinghouses or different brokers are on the status of the rest of the market. Funny enough, you see plenty of people try to take advantage of that and try to very much try to take advantage of that. And at some points you could even ask like, where are all these assets and who owns what? And you can even see that there's more of an asset sold than there currently is supposed to be, solely based on the fact that people are very much in the dark. That's one of the biggest things about, I think, one of the biggest things about the, what's a good way to put it? One of the biggest things about the integrity of having assets on chain and the visibility of having assets on chain, you can see if there's 100% of a given asset, you can see where those assets are, where those assets move to, and where those assets are going without having to guess of like 10 different clearinghouses, 10 different brokers, 10 different people trying to coordinate which is what, how is this going, how are you able
there's
to
no
sell,
double spin.
Yeah.
So you can't rehypothecate and like trade. That's the whole gold market, right? And silver too, is there's way more paper than the underlying collateral. So if you had a one-to-one backing and you could not issue more than that, then it basically removes their capability. Well, I don't want to say it removes their capability to manipulate the market because it's still going to be a derivative, and you could still spoof and do some of the other things that they do.
But it'll be out in the open. It'll be one of those things that's out in the open.
Right.
Like it'd be hard to get away with it. Let's put it that way.
Yeah. The transparency that it would cause, and then the trust would be there, right? Because right now I think a lot of people don't trust almost anything. They know that it's being manipulated, and that's the narrative, that they've kind of fed everybody, and everybody's aware of it, probably more so now than they've ever been. And so I think that'll be a catalyst for adoption also. There's going to be a lot of people that encourage this and want it. I want to pivot here and ask you about voting on blockchain. Do you think there's any potential for the election to move on chain?
Funny enough, ooh. So in theory,
talk about it. Never mind.
No. I love to talk about it. In theory, being able to run elections on chain would be obviously amazing. Being able to check the integrity of any given election or any given vote. Now, I don't necessarily. This is one of those things where everybody wants to talk about the technology until you realize it's not really about the technology. It's about how it's being implemented. So yeah, let's say if your vote were to be placed on chain and to be counted on chain, great. But the real question is what machines are going to be done for that, how people are going to cast their vote, if people are able to cast their vote in person or online or by mail. There's like all these now, like I said, at the end of the day, if you wanted to take that last paper vote and tally it on chain, that'd be brilliant. But it almost seems like now we're almost moving more towards paper voting than we are towards digital voting.
I view it as like American Idol. Okay.
Yeah.
Remember, like, they encourage you to vote on your phone, right? And obviously all that stuff was fixed, and we knew it was, but we still did it anyway, With this, though, I think if you had a biometric where you had to verify that you're alive and that it's you, and then you can't double vote, right? You can't mail one in and go in person. I think it would just, fix a lot of the problems and the potential issues that have occurred with, I don't know if things were fixed or, there was voter fraud or whatever else. People have their own narrative. I'm just saying, like, for me, I think that it would be a much more effective tool than what currently exists to facilitate the voting, especially if again, you had to verify that you were alive and that it's you by a biometric.
I'm so glad you brought that up. I'm so because this is one of the key things. It just happens with trade finance. It happens with voting. It's not even really about voting. It's about all the different things that lead up to make that possible. So first, you need identity management. First, you need that. Then once you can identify people's identities, then you can add voting, add tokenization, add trade finance. And it's not even just that too, because maybe there's an element of the document. Like maybe you need to be able to tokenize the document to be able to preserve the integrity of the vote, to make sure that someone isn't trying to mess with this.
It needs to be encrypted so that it can't be hacked and changed and manipulated, right?
Yep. So it's like, it's not even just that there needs to be one thing for voting. It's like there needs to be multiple layers of different technologies to be able to create this service that is voting, identity management, voting, maintaining the integrity of certain documents, being able to keep a level of transparency. You know what I mean? There are all these things stacked on top of each other to be able to create that service of voting. But at the same time, like I said, the identity management is just as important as the voting component. So.
When you could have real-time analytics on the election without people reporting from their counting in their county, right?
Yep. And then having people like, all right, we counted the paper votes. All right, we affirmed
the recount
votes. Yeah, we got to recount. Yeah, people counting them again.
Yeah. You'd be able to verify that data real time. It would be transparent. It would be easily, I see a lot of benefit there. So there was a blockchain voting patent that was filed for by the post office in, I think it was 20 or 19 while Trump was in office. Anyway, I don't know that that'll be in vogue for this election or that it'll be the capability will exist. I'm hopeful though. I think that it would be a huge paradigm shift for people if that was implemented at scale for a national election. And this year we've got more elections across the world than we've ever had all at one time. I think there's like 140 countries all voting on new leaders. So, it'd be a great time to implement it. We'll see. Got a few questions. We said, Matt says, so far away from digital voting, half the country doesn't trust machines, but you trust your phone. And who's, I would think that 99% of the population that is of voting age has a phone.
Yeah, absolutely.
It would be difficult for me to think that there was more than 1% of the population that was capable of voting that doesn't have a phone. And I think that would actually allow more people to vote. I think it would be more inclusive than, having to go down to wherever you were, take time off work, travel, drive by the post office and put your vote in the vet.
It's practically a holiday voting. Like, you had to take a whole day to be able to set all this up, just to go to some place, stand in a line, cast your vote just for someone to contest it, and then count it again.
Yeah. So, you mentioned, and it seems like we're getting closer and closer to this. You did a video on like NFTs and the capabilities for self-driving cars. What do you think? Like, it's so interesting to me, the different applications for this technology and kind of how there's multiple for the same things. So like you mentioned there, like you have to have the digital identity component, but you could also have the security component of things being on chain and encrypted. And then you got the smart contract capability that, could facilitate some of the things. Can you speak to like some of the efficiencies that can be obtained by the implementation of this technology in IoT or the Internet of Things? And then how far away from that are we?
Yeah, so actually this is beautiful. I just spoke to somebody just a few days ago about this in terms of being able to create, let's just call them tags for IoT devices. So right now, one of the biggest problems with IoT devices is they need to connect with every other device and be able to identify all of the devices. And it's very difficult to do that, especially in terms of managing identity and verifying just the integrity of another device. But being able to recognize other devices by the identity that they represent on chain, and they just reading the chain to be able to confirm other devices, or at the very least be able to confirm the identity of other devices, whether it's in the form of a token or whatever, is a lot easier than trying to send a bunch of tags back and forth, whether it's over Wi-Fi, Bluetooth, internet, to verify. So there's this idea of, let's say every single IoT device had a specific tag on it, and that tag was a token, and then it possessed that token. So every single time it tried to interact with another device, it would just share a signature. That signature would correlate to that address, and that address would have that token with that tag in it, verifying that it's that particular device. It's a lot easier to do that, and do that with 1 million devices, than each device telling the other 1 million devices who it is, and how it's trying to communicate, and trying to verify, and trying to make sure it's not compromised, and all of that. So there's an element where you can keep track of certain, let's call it like, you can keep track of like certain variables that would be relatively difficult at scale for IoT devices to share. So like the example with self-driving cars, instead of each self-driving car having like a specific tag that is trying to broadcast to all the other self-driving cars, it may have a particular token that may have its identity or VIN number or whatever associated with it, and then it may just be sharing a signature or something. And that's the thing. It's not that it needs to read that signature to verify it. It just needs to recognize that signature correlates to this address. This address has this token, and this token has whatever thing that means. It could be a vehicle ID number. It could be your what's it called, your license plate. It could be even associated with a driver's license or even insurance. Who knows what it may be. But the biggest thing is you could use these tokens as a form of identification, and then read the blockchain to be able to coordinate that identification, rather than each individual item having its own database and then trying to send messages back and forth to sync each other's databases.
I have a partner that I'd like you to talk to about.
I'd love to. Let's do it. Yeah.
We have some proprietary stuff that we're working on that I think you could add a lot of value to.
Hey, let's hook it up.
Specifically for that application. So, I think you'd be interested. It's a good thing we got going, but I think maybe the full scope and the potential use cases we just haven't thought all the way through. Obviously, and that's what I'm saying. Like, I think the same information, if it was tagged on chain, could be used in a ton of different use cases for different benefits. Mm-hmm. Right. Mm-hmm. So like that same car, if you took it to the mechanic and he could verify that information, he could look at the insurance, the warranties, the previous work that's done on it.
Yep. And these can all be recognized as tokens as well. That's another thing. Right. Every single component, whether it's a part of the car, whether it's a maintenance piece, whether it's just a quote on something that could have been a problem, these can be recognized as tokens and be recognized by third parties. And, oh, this is what happened here. This is what we're recognizing in terms of who owns the car. This is what we're recognizing in terms of these components have been worked on the car. These are the components that we're recognizing in terms of all the parts that make up the car. These are all can be recognized as tokens, and all the token is just a unit of account with some data associated to it, and it being on the blockchain just allows you to preserve its integrity. That's it. Since it's on the blockchain, since it's as a token, nobody can go manipulate some third-party database to falsify some information. It's there. It is as it is, and you're able to recognize it, you're able to interact with it, and you're able to verify that it's true.
Yeah, the insurance companies would love this. They wouldn't need, well, I won't say that you wouldn't need underwriters, but like a lot of their job would become significantly easier once this technology is used in that application. You know, if somebody comes out and they got an accident, you could probably just verify all the data on chain. You know, especially if the cars are self-driving. And somebody moved it into manual mode or something. I think that things will just become much, and that's the other crazy part to me is, like we talked about the volume of transactions on a network at scale right now, with all of the frictions that currently exist in the system. When this stuff is implemented, those go away. And so what happens to the volume then? Like, now that there are no frictions, or much less friction in the system, does the volume of transactions go up exponentially? Like, is it a 10x? Like, and I talk about mail, right? So postal service, you know, you got, it used to take, like, and it still does, you know, if you wanted to send a letter across the country, it might take 5 or 7 days before it gets to the other person and they can read it. Or you can send an email. How many emails could you send back and forth in those 5 to 7 days versus one letter? And so I think that'll happen in a lot of different use cases where there's delay or friction right now. The volume of transactions that'll happen at scale once this stuff is implemented actually will be, I would love to see the metrics on this. If somebody could find it, like the amount of mail that used to be sent via postal, before the internet and before email versus how many messages are sent per day now. Like,
I think a good example of that is like what type of economic growth do we see from market efficiencies? I like the idea with mail and email, but I think another good example could be what is it like to be able to grow an economy versus using a debit card / credit card versus just straight cash? And simply just based on the fact of convenience, simply based on the fact of being able to go to multiple, and I only say that because it's not like people in the past were just holding thousands of dollars in cash, but now you can go to, the Apple store, swipe a card, pay thousands of dollars for goods, and you can very easily have higher efficiency and higher market efficiencies that can allow for a larger economic growth. And I only say this because maybe it's only by 20%, but the thing is even if it's by 20%, whatever growth you would have seen now increased by 20% in terms of the total market efficiency. So you're gonna see that growth on top of that as well. And I think that goes in every, and that maybe 20% is like an arbitrary number. It could be 50%, it could be 10%, it could be 1%. But that increasing the efficiency will just allow for there to be more activity. I always like to make this association with tokens. So currently, it may take, I bet you're probably familiar with this, 24, 48 hours, 3 days, a weekend for a settlement to process. But what is the market efficiency for that settlement to be processed in seconds? Now, instead of capital being held up, sitting there waiting for a couple days or even the weekend, you're able to liquidate that capital instantly and then be able to you take that working capital and move it towards something else quicker. So instead of you having to wait the weekend or wait 48 hours for there to be settlement, you had instant settlement and you can take that capital and have it work for you now. And because you're able to do that now, what are all the things that you can do now that you weren't able to do before because you're able to move this capital around a lot quicker?
The markets and the way things are traded by bots at scale will just become even more crazy. Like, if you didn't have to wait on payment, so here's the other component of this though that I don't think most people discuss, and that's the impact on inflation if you did have velocity pickup for the money across an economy. Because then it goes back to supply and demand. You've got more volume, more transactions on scarcity of goods or a finite amount of goods, right? So the two components for inflation in an economy are M2 money supply, how much money is out there in people's hands, and then also how fast it's moving from hand to hand.
Yep.
And currently the velocity of money is the lowest that it's ever been in recorded history. If the metrics are, not manipulated, which we know they are. I don't know how low it is or if it's accurate. If you think the CPI is accurate, then, Yeah. So, but, based on the data that we have, it is the lowest it's ever been. And the Fed and governments have never had a way to manipulate velocity of money. They've never been able to incentivize people to spend. The only way that you do that is you can move the interest rate, right? And by doing that by proxy,
and maybe tax cuts on the
well, you can provide tax incentives and other stuff, right? But you've never directly been able to influence people's spending. But if let's say we do get some type of UBI or stimmy checks or whatever, if they could put a time constraint on that capital, and if you didn't spend it in whatever time frame, like now you lose it, then you could have a direct driver or lever that you could pull on the velocity of money across an economy,
and vice versa. Instead of having to rely on the banks having to trickle down an interest rate, you could just give interest rates directly to people. So it's just like, hey, you want people to save? We increase the interest rate, we deliver some sort of capital, and because the interest rate's higher, you're more incentivized to save, and because you're getting that directly rather than some bank giving you 0.05% of a savings rate, you can see there being different incentives to have people save or different incentives to have people buy. So it's very interesting how you bringing that up, because there are a lot of different ways that you can be able to manipulate or let's say control macroeconomic behavior simply based off of the velocity of money. I guess that's the way to put it.
Kenny G has asked, can they tax P2P payments?
Actually,
go ahead.
it's no. I was gonna say actually yeah. You might actually see this. Here's a good way to put it. So let's say there was a stable coin, right? Whatever, right? There's a USDC or not USDC. A CBDC. And let's say that was a stable coin, right? The tax rate may be implemented in the burn rate of you using it. So, normally you may go, oh, there's a CBDC, there's a, 50 basis point burn rate for whatever. That may be the tax rate, actually. That may be the tax rate for a CBDC. The burn on a particular transaction. So instead of having to rely on you or the secondary party or the third party facilitating the transaction to pay the taxes, they may essentially be able to, and it may not be a burn rate, it may be...
that's an interesting concept you bring up there, because if it was implemented that way over time, and it was a finite fixed amount of USDC or whatever it was, right? If they're not printing more of it every single year, you would actually be incentivized to save, right? Because it would be inherently deflationary, and the value of it would go up over time, because the more that was spent across the economy, if the tax was burnt, then like XRP operates like that. There's a small portion that's burnt on every single transaction, and the amount is actually fixed. All of it's that it was ever going to be issued or been issued. So if our currency supply was the same way, yeah, I'd be all for that. I think that would be a really solid way to have backed currency, and the people that were good stewards of capital. Well, I say that you would be wise with your spending. if you would think about it a little bit more, if you knew that your currency was going to hold value, versus the way it is now, like you're basically incentivized to take out debt and just spend that.
I think that just shows you the difference. Like, I guess that shows like what it would look like in a crypto system, but I think that just shows you the difference between the fiat system and the gold system we used to be on. When we were on the gold system, there was an element where it's like, well, actually, there may be a possibility that my currency may be worth more and I could spend more. Now that we're on a fiat system that's primarily inflationary based, everyone's like, well, my money's worth less every year. Might as well spend, right? Might as well stimulate the economy, right? Like, but no, seriously, you can very much have that component where you could, and that also gets into what it means to be able to create incentives around these different economies. Because there may be certain instances where you want people to save, but it's hard to say, hey, everybody start saving. So what type of incentives can you place to be able to guide that behavior? Now, don't get me wrong. Some people may like that idea. Some people may hate that idea. But it doesn't change the fact that technology can facilitate that.
Right. Well, that's my deal. Like, I probably have a different view than most people on this. I don't think that we get a utopia or a dystopia. I think it's somewhere in the middle. But I think that there's... again, people aren't going to like this, a sustainable way that you could have the benefits of some socialism along with capitalism in the same economy. I think maybe even China's starting to trial this. There's people in the comments here that have pointed out social credit scores and stuff in China. I'm not a fan of that. I don't like where a government can just say, nope, you can't spend. We lock all your banking. But they can do that to you now. You just don't think they can.
Yeah. I mean, they can garnish your wages now. They can garnish your wages. They can put a lien on your house. Like, there are a lot of things that can be done.
When I was at CoinAlts, got to listen to Brad and Jack speak and the keynote, and Brad talked about when the SEC sued him and Chris Larson, like specifically along with Ripple, and he said, his bank accounts were just locked. And he didn't have access to capital, like relationships that he had for decades, like gone, Damn. And so just it can happen to anybody. If there's justification for it, the government wants to lock up your stuff, or somebody doesn't want to do business with you anymore. They have the right to do business with whoever they want. They can just decide to close your accounts. I've seen it happen to people that are trading crypto with Chase, Bank of America. There's been a ton of banks that have just decided, nope, don't want to deal with you anymore. I'm going to lock your account, close it, liquidate it. So this will make it easier. But I think it creates the benefits far outweigh the potential problems associated with this. And I do think that different parts of the world will utilize the technology in different ways that align with their social norms and culture. So I don't ever see us having a social credit score here in the US. But I do think there is a possibility where different currencies and stable coins or private stable coins are issued, and you haven't, just like you use credit cards to get cash back, right?
There you go. There you go.
You might use one specifically for airline points, or you get better cash back on gas, or whatever it is. There'll be stable coins that have specific components built into the smart contract for them that incentivize you to spend them in certain sectors of the economy, incentivize saving, incentivize whatever the steward that's issuing that capital wants to incentivize. So, and maybe at some point we're able to issue our own stable coins. I think that would be cool. Like depending on what digital assets are tier one collateral or can be used as collateral, I think there might be a situation where you can lock those with a custodian and then potentially issue your own stable coins against your collateral. What do you think about that?
Actually, I'm glad you brought something like that up because I think the ability for tokenization will allow for a lot of other things to be put up for collateral that would be relatively difficult to do so. Because there are a lot of things that are very valuable, but they're not very liquid, are they? So being able to put it down as collateral it may be worth a couple $1,000s, but if you can't sell it, what does it mean? And I think tokenization will allow for a furtherance in the liquidity for these illiquid assets, while simultaneously you being able to take these assets and do more with them. Because people go, oh, what's the point of tokenization? No, I have this token now. Well, guess what, actually? Because you now have this token, and because we can now, like recognize this token, you can actually use this as, let's say, for instance, somebody wanted to be able to take a subset of assets that they may have held that they otherwise weren't able to recognize, but they can recognize as tokens, and they can potentially use that as collateral for a down payment on their house. Like, sort of what you said with the stable coins. What if they were to use that to be able to get out a loan? And maybe it's not them being issued a stable coin, but maybe it's the bank issuing them a stable coin in the form of a loan, and then them being able to say, hey, look, I have these bank stable coins, in the form of whatever, and then maybe you pay it back in the stable coin, who knows? But I have these bank stable coins that are backed by this collateral that I may have that would otherwise been illiquid, but that has been tokenized, and now I'm able to take this collateral and be able to issue the value towards things that would otherwise be relatively difficult. And this could be something as simple as like your car, let's say you're like just a little bit below, like you have 50K, 60K and a down payment, and let's say you just want to get a little bit above that, and you're able to put your car down as collateral. Now, obviously, it may be a little bit of a risky move, but hey, it's relatively hard to be able to do that now. So,
there might be applications where there's DeFi to be able to do this, right? So you no longer have to go to some of the fiduciary or bank. You're able to just lock that again. It's going to have to be held with a qualified custodian. You're going to have identity, and you're going to have custody in place for any of these, again, sexy things to exist. Those are the boring bedrocks of this whole deal. But once they have those in regulation, I think that there's going to be a lot of applications that are built out that, democratize access to this stuff. You'll probably still be subject to a credit pool and some other things, but there may be pools of people that pool their capital together, and then as long as you meet the qualifications, they'll issue you a loan out of their pool, right? And maybe you have to put up some type of collateral that's your NFT, that's your ownership to whatever else.
Another example too. No one ever really thinks about this. When I used to work, I've told you this before. I used to work at a PE firm, and it's funny because one of the things that we were doing, and we thought we were super innovative about this. Mostly businesses would try to. We would lend money to businesses for them to be able to buy equipment for their businesses, like whether it's like refrigerators or heavy machinery or something. And for the longest time, you would evaluate the credit score of the business owners. You would evaluate the income and cash flow. Imagine if they could take a lot of these illiquid assets that they have, all part of their business, whether it's machinery, whether it's whatever, or even illiquid processes that generate revenue. Because that was actually the thing that we thought we were clever on. We're like, hey, look, we may not be able to tell, how effective you are in being able to pay this back, but if we can prove how much revenue you're able to generate over time, we could use that not quite as collateral, but as a justification for lending you this loan because we can see that. Now imagine being able to automate that. Imagine being able to issue a loan and then be able to get a portion of the guaranteed revenue based off of a smart contract, based off of that loan, based off the productivity that came off of that. You know, let's say they bought some machinery and it runs their business, and you're able to off of a smart contract take 2% of the fees off of that process to help pay back that loan. Like that. Now I say that because we were trying to automate that in the cloud. Like that was like my whole thing, trying to automate that in the cloud. It's hard, man. It's hard. But a smart contract can fundamentally do that, you know?
Yeah, I think there'll be again a lot of ways that you can put up collateral for loans that don't exist now. A lot of innovative ways, like imagine you could track lifetime value of a person and their productivity in a society, right? And then that's basically their line of credit that they could draw against.
Ooh.
So you like.
No, I like that you bring that up because what if they have multiple forms of income, but they can only prove their W-2? And it's like, well, how am I supposed to show all these elements in which I can be able to pay or can be able to pay this back? But then I have to, maybe I'm trying to show all these forms of income, all this. But if I'm able to go, hey, look, you're able to see all of this, or you're able to engage with all of this, and you don't necessarily need one criteria to be able to evaluate me, or at least evaluate my ability to continuously generate revenue. You can see these forms of revenue being generated. Right. That can very much be used as a tool to be able to allow people to have access to capital they otherwise wouldn't have been able to have access to.
Yeah, you don't necessarily need to prove your credit score. You just need to be able to prove that you can pay the loan back.
Yeah, exactly. Because honestly, they don't even care about the credit score. They say about, hey, we can make our money back. Let's talk.
And you could automate. So, like Stripe does this. Stripe will issue you a loan, and then they're like, take a percentage of each transaction to pay that back over time. I don't know if you've seen that, but there's other payment providers that do the same thing.
That's cool.
So they automate it, like they can see your cash flow statement over whatever period you've been processing payments on the platform, and then they'll send you a thing and they're like, hey, we'll loan you this much, and it's going to be this much of each payment to pay it back over a period of time. I think that'll be a thing, especially, and you again can automate it with smart contracts. So like you're talking about the revenue that's produced by this machine, any of the transactions that are correlated with that. In the smart contract, a portion of that revenue goes back to the lender.
Exactly. And it actually shows a lot of that offsets a lot of anxiety and shows a lot of trust, because now they're not even really evaluating your ability to pay it back. They're evaluating how much economic productivity this loan would give you and what that means for your ability to pay it back. And to be honest, if it seems like you could, then you'd be able to have access to a loan that you otherwise wouldn't have been able to, or it would have been relatively difficult to, or at the very least relatively complex to go and pay it back or prove your ability to pay it back, or whatever it may have been. You may be able to just show growth of your business as a means of being able to pay back a loan.
Yeah, I think it'll unlock a lot of doors. I do see people kind of dwindling here and dropping off. Do you want to wrap it up for the evening?
Yeah. You have any final thoughts? Any final ideas?
I'm just excited for all the stuff that's going to be built in this space over the next 3 to 5 years, man. I think you're one of those people that's on the bleeding edge, and it's really cool to be able to have a conversation with you in the public eye and kind of share thoughts and like go back and forth. So I appreciate you coming on, and just really excited to see the actual implementation of this technology in the economy and the efficiencies that creates. And I think it's going to blow people's mind. I don't think people are ready for the implications of this at scale. And I think those that, like the people that are watching this and the people that are in this space, you get it. You're going to be ahead of the curve. You probably have a really good idea of, some of the, a lot of the things we discussed tonight. But the average person that's out there has no clue. Mm-hmm. They're just going to be
these are very niche, esoteric fields to begin with, and then now we're talking about the innovation of technologies in those fields, and then how people utilize these technologies. A lot of people are not very familiar. Like at the end of the day, the average person may be on the other end of the product that's produced, but there's so many services that are in between the technology that's being facilitated and the products that are being built with it that a lot of people just don't have experience with them.
Yeah, well, and I've talked about this before too. Like, it needs to be so easy that grandma can use it, and she's not even going to know she's using the tech, right?
Exactly.
Once it's at scale like that, all the money's been made, though. I mean, there'll still be money made, but it won't be the blue ocean that it is today. Like the people that are innovative now and taking advantage of this technology and getting to market, there's going to be multiple billionaires made over the
Oh,
next few years.
absolutely, absolutely. I think this is almost akin to like the internet, in a sense.
Yeah,
When the internet first started blowing up, in terms of like websites, everybody and their mother wanted to create a website, and honestly, anybody can create a website now. But how many billionaires have been created solely based off of a service that you go through by accessing a website? And it's not like those services couldn't exist before, but the ease of access, whether it's a website or an application, a mobile application, has allowed for people to be able to scale up businesses in such a way that they otherwise wouldn't have been able to before. Same sort of thing here with tokenization, same sort of here with real world assets, same sort of thing here with being able to conduct in global trade. But at the same time, you almost have to understand what are the benefits to be able to capitalize off that, and then being able to see what deficits there are on the market to be able to jump on and be able to market off of.
yeah. Well, I mean, you asked me. Do you have any closing thoughts you want to wrap it up with?
I guess the last thing I might say is one of the biggest things that I think is going to be very focused on in the next coming years is the tokenization of real world assets. But the biggest thing is just tokenization in general. And the biggest value point is being able to bridge these siloed economies in such a way to where people are able to engage a lot quicker, a lot cheaper, a lot more efficiently, and you're going to see a whole slew of new businesses operating off of this. There have been trade finance for hundreds of years, modern trade finance for like 100 years now. But what type of efficiencies can you put on top of that with tokenization? What type of efficiencies can you put on top of that with being able to take different forms of collateral, or being able to take different forms of revenue and being able to automate, paying back a loan, or automate being able to get a loan based off that capital, whatever it may be. All these services exist. It's just the efficiencies that you're able to have with this tokenization, with these smart contracts, with these blockchain networks, that I think is going to create a whole new world in terms of how we're able to engage with value online. And I think most people are familiar with engaging with value online through a particular entity, and I think that's going to become less and less of a thing, and we're going to have more autonomy over our own value, our own assets, in terms of being able to exchange with each other. And it sounds like a lot, but in reality, all it means is the rate at which you're able to engage is faster, the fees in which you're able to do it is quicker, and you don't need to rely on somebody to do it for you. That's really what that means. So
Yeah. Removes the intermediaries and the friction and the people that are sucking liquidity out of the system. And they realize that, and that's why you see Visa and MasterCard and all of these payment providers at all these conferences, because they know if they don't adopt this technology and use it in some capacity, they'll just be eradicated, right? They'll be a blockbuster after Netflix. So anyway, yeah, I really appreciate you coming on here.
Appreciate having me, man. I always love these conversations, man. I always love it.
It's like I said, it's really cool to have somebody else in the space that I can nerd out with on macroeconomics and like all the other the few competencies that I do have. I really enjoy our conversation. So if you guys haven't liked already, like, subscribe. Appreciate you guys coming on the channel. Hopefully this has provided you some value, and we'll see you guys on the next one.
Appreciate it.